Hey guys, my name is David, and in this video, I will be breaking down the income statement and highlighting some of the major components found in the statement and key aspects within those components that are key to properly analyzing any company's income statement. This is the second of 3 videos that I've created on how to analyze a company's financial statements, and similar to the first video, I'll be using Foot Locker as an exemplar company. If you haven't watched the other videos in this series, I highly recommend checking them out, and I've linked both of them in the description below. Now, let's get into it. Unlike the balance sheet, I like to keep these numbers as reported, so there's no need to add 3 zeros at the end of each number that we will be seeing. Also, unlike the balance sheet, I typically like to look at the past 5 to 10 year trend of fiscal income statement reports very closely, as they are one of the main indicators of how a company is performing over time. Let's get into the first line, called revenue, which represents how much money the company is able to bring into the business through sales. In Foot Locker's case, that revenue mainly comes from selling shoes, and the company has had consistent growth over the past 5 years. Unfortunately, while consistent, the company has not been growing at a high rate and has only increased revenues by around 8% within the past 5 years. The line just underneath tells us how much the components of what they're selling cost them. In Foot Locker's case, their 2019-2020 year, we can see that it cost them just over $5.4 billion to achieve $8 billion in revenue. When we subtract revenue from the cost of revenue, we get something called gross profit, which gives us a better picture of how the company is performing. Gross profits can also be used to find Foot Locker's gross margin. We just need to take Foot Locker's gross profits, which is $2.55 billion, and divide it by their revenue of $8 billion to get a gross margin of around 31%. For retail, that gross margin is around average, and often acceptable gross margins will vary significantly depending on the industry that we're looking at. Next, we have operating expenses, which include many different expenses a business might have on a regular basis. The main expense Foot Locker has falls under sales, general, and administrative, and this section is allocated to all of the sales workers and administrative jobs that the company needs in order to keep track of and sell their products. This can include things like advertising, marketing, management costs, and in Foot Locker's case, sales commissions earned by employees. Another popular operating expense that falls under this category is research and development, which is commonly used by many growth-based companies such as Google and Amazon. Foot Locker had around $1.8 billion worth of operating expenses that they incurred in the 2019-2020 year, which, like gross profit, seems to be pretty stagnant over the past 5 years. When we subtract operating expenses from gross profits, we get something called Foot Locker's operating income, which is totaled at around $710 million. Using operating profits, we can also find the operating margin, which is calculated by dividing operating profits by revenue. Foot Locker has an operating margin of only around 9%, and typically companies have an operating margin of around 15%, but this can of course vary very largely based on industries. Next, we need to factor interest and taxes into Foot Locker's operating profit to get something called net income. First up, we subtract Foot Locker's interest expenses, which is just how much they paid in terms of interest onto things such as bonds, loans, or lines of credit. Then, underneath, we have other income/expenses, which is just any other expenses or income the business generated that isn't related to their core operations and can be a variety of things. In Foot Locker's case, they generated negative $28 million, which would constitute this section as an expense and not an income. When we subtract both of these, we get Foot Locker's income before taxes. And the last step to getting net income is of course subtracting the $181 million in taxes Foot Locker must pay, leaving us with around $490 million in net income for their 2019-2020 year. This number has been pretty stagnant over the past few years, which is not surprising considering Foot Locker's minimal revenue growth. A lot of investors might have heard of something called earnings per share or EPS, which is actually found in the income statement, and it is calculated by dividing a company's net income by however many shares Foot Locker has. In Foot Locker's case, the company has 109 million outstanding basic shares and net income of $490 million. I tend to prefer using that diluted share figure, which includes all potential shares the company might have at the moment due to executives being paid in shares of the company. We see Foot Locker has diluted EPS of around $4.5 per share, which has grown a bit over the past 5 years. Sometimes, investors use EPS and compare it to the price a company is currently trading at, which is called a PE ratio. And this is just one of the most widely used ratios in investing. And to calculate it, you simply just need to divide the price of a stock by their earnings per share. In Foot Locker's case, their PE ratio is around 6, which hints that there isn't much growth being expected for the company in the future. Lastly, we can see a figure further down called EBITDA. This stands for earnings before interest, taxes, depreciation, and amortization. This is sometimes used in substitution with net income. However, I only use the figure to compare similar companies in an industry, as it gives a more accurate comparison between two companies. Overall, I tend to prefer revenue and EPS both consistently growing at around 10% or more each year. And while this definitely isn't the case with Foot Locker, the company has been growing amidst a change in how the retail industry as a whole functions. If the company can perform a successful turnaround and expand their presence online as well as in Asia, it could definitely allow them to grow at a much faster rate than we are currently seeing. Hope you guys enjoyed watching this video, and if you guys stayed until the end, please smash that like button for the YouTube algorithm and feel free to sub if you enjoyed, and as always, have a great day.